fine to start.
Okay, so thank you very much for attending this second Crypto Asset Lab conference. We are at the parallel session dedicated to crypto economics. We have 5 papers to be presented, and the presenters are all here, so we can start. Each presenter has 15 minutes for his presentation because they are all men. And we see there are very few women in this conference, at least as a presenter. We have some panelists. So we need to think about gender gap, as our rector was mentioning at the beginning of the conference. And then after each presentation, we leave some time to the floor for questions and then move to the other one. So I think the first one to start is Mario Bellia. And please take the floor and start presenting. I think you can share, yes, you can share your screen. You can go ahead.
Okay, thank you very much. Thank you very much. Thanks for selecting our paper for the presentation of this very interesting conference. So first of all, this is a joint work with myself together with Sebastian Schich from the OECD. And of course, the usual disclaimer applies. So the views is our own and cannot be attributed to the European Commission and the OECD as well. So first of all, our motivation. We start from the point that stable coins, which we will define in a few seconds, needs to be understood against the whole background of a Bitcoin, which was born as an alternative to the money created by a central bank and the banking system. Unfortunately, the issue, which is still an issue for Bitcoin in becoming actually money, is the fact that it cannot be considered as a stable currency because of its very, very high volatility against with other fiat currency. So what the market came up with this new type of cyber cryptocurrency, which is called stablecoins, that has been proposed exactly to address this issue. So first of all, there is no generally agreed single definition of stablecoin, albeit there is a lot of ongoing work by the regulators. This is the following, these 3 characteristics are the one that we define to, let's say, to run our empirical analysis. And we are talking about somehow a digital token, which is traded on a crypto exchange and promise to be stable against something, which can be fiat currency, such as the US dollar, the euro, the Swiss franc, or whatever, or some other asset, even crypto asset. The token aspires to become money. So to say, at the minimum to perform the store of value and payment function. And if it is successful in this regard, it would be more similar to somehow digital cash rather than credit money. So more like digital cash than a loan or something else. And this token might or might not be backed by something. This is one very interesting point, especially for our empirical analysis, because we argue that the quality of the collateral and of the backing is a crucial determinant for the stability. And this outcome is directly linked to the credibility of the stablecoin itself and from the existing system and the financial safety net. So if there is somehow fiat collateral, we know that there is at least a banking system behind the fiat collateral or the usual system for circulation of money. And this is a direct link for the financial safety net in case of bank run or other issues that might be very severe for cryptocurrencies. So as I said a few seconds ago, the regulatory framework, especially in Europe, is very quickly evolving. So for instance, the very recent digital package from the European Union has been published on 24th of September 2020, so pretty much a month ago. So we go back to 1966, and as I said, old but gold. Hayek says in his very old paper that he was saying that somehow we need market to select among the contenders for money in a way that is the market which decided which primate money can support and can be supported and can also fail. So he assumed that the criteria to such a competition of primate monies will be the stability performance. And another important point is the following, that what can make a private money stable or not, he said that is, let's say, impossible for a piece of paper or other tokens without any significant market value. So it's not that a stable coin is something like a gold or a bar of gold. It's something completely immaterial. And is somehow impossible that these immaterial things become money unless they represent a claim on something that is valuable. So in that case, to be accepted as a money, they derive their value from another source. So for instance, the convertibility into another kind of money. This very old work by Hayek somehow justify and inspire our empirical analysis. So we investigate to what extent the traded stable coins in the market derive the stability from different type of collateral or backings. And I give you a preview of the results. The stable coin needs to be more stable as long as they can show that they are fully and credibly backed by something like fiat currency. And so they are very close to the current monetary and payment system. So to get back to the previous point, they are very close to the financial safety net. So in our paper, we identified three types of, let's say, stable coins. This is our own taxonomy. There are a lot of taxonomies ongoing. We somehow tailored this taxonomy for our empirical analysis. The first, we define it as a pseudo-currency board that have 100% reserves. So they promise to redeem token and par against fiat currency. So if I'm having one tether, like in this example, that is worth $1, if I'm exchanging the tether, I will get back $1 US. They promise, or at least they say, to be backed by 100% of reserve. And as I said, one example is tether. There is another type, which we call pseudo-commercial bank, with over collateralization. So the stable coins are issued against debt backed by crypto assets, and the mechanism is similar to the one of deposits obtained when borrowing from a bank. One example of this stablecoin is DAI, and the third is pseudo central bank with no collateral. So in this case, the adjustment are made by the stability is obtaining adjusting supply and demand of the token. Buying and selling from another token. This is similar to the work of the central bank that is buying and selling fiat currency, and one example is Nubits. So the market is growing quite substantially in the last few years, and you can see from the left panel in terms of billion is pretty big, and of course, let's say you see from the right panel that the amount, the percentage, the relative percentage is, let's say, more than 94% for pseudo-currency board, so backed at 100% by fiat currency rather than from the other two types, so pseudo-central bank and pseudo-commercial bank. So as you can see, of course, the right panel starts from 90%, so it's a very tiny percentage of the other. But still, it's very interesting to study what's going on and see if these other types of stable coins might be adopted in the future. So again, we said at the beginning that the problem of the crypto asset and Bitcoin in particular is the volatility of the price, so the instability in terms of price volatility. This is a very simple box plot where we plot our three categories and against other crypto assets. These are the top 10 crypto assets in terms of market capitalization. And of course, we have a ranking that, let's say, see that the pseudo-currency board are the least volatile, followed by commercial bank, central bank, and of course, we have all the other crypto assets that are having a very, very high volatility. So our data comes from CoinMarketCap, and we select 14 pseudo-currency board, 10 pseudo-commercial bank, and 7 pseudo-central bank. 23 of them have some form of collateral, fiat money, gold, or a combination with fiat money and crypto asset. 8 have no collateral, and almost all of them are the one that we define as central bank. So they have no collateral, they are just adjusting their stability through buying and selling the tokens. 11 report to have at least one regulatory license, and there are many of them, and so far there is not a, let's say, unified regulatory license. 12 of them says that they have been formally audited, and for some of them it's not that easy to verify that part. And the 11 stable coins promise to be stable with the US dollar, and we also have other type of currency like the pound, the Swiss franc, euro, and also a basket of stable coin, and we have 2 of them that are pegged to the gold. So let's go to the empirical analysis. We consider 4 measures of price stability. The first is a very simple monthly standard deviation return. Then we use a more refined version, which is like a moving average 15 days standard deviation of returns. Then we have 2 measures that, let's say, are related to the price deviation from 1, because we are we assume that the stablecoin is with a ratio 1-to-1 to the pegged coin, so the US dollar, for instance. So we have the deviation that is just the closing price -1. So the higher the deviation, the more difficult it is to be close to the peg, so to the parity. And then derived to that, there is what we define, and is also defined to the literature, the half-life. So it's pretty much an estimation of an autoregressive processor owner 1 on the deviation, which is the previous measure, and calculated with this formula. And pretty much we can say that this is a measure on how much a shock takes to dissipate by 0.5, so by 1/2. So this is a measure of dynamic stability rather than the other that is just the average deviation. We calculated this measure for all these variables, and we average across daily data, and we have monthly data at the end. So this is the specification. It's very simple. We just want to know which one is somehow better in terms of price stability compared to all the other. And we run, these are the dynamic panel regression, so we include also the autoregressive component, 1 lag. And we have 3 basic specifications. The first one, we just check what's going on for the 3 type of stable coins, so currency board, central bank, and commercial bank. And we have and we just have the 2 of them, and we exclude the commercial bank that serve as a baseline. The second is the collateral used, so fiat collateral, gold collateral, or algorithmic collateral. And then the third one is just to see if there are differences with the group of stable coins which are having a license and audit and the other. And then we pretty much use the interaction term between these between these groups to figure it out to have an overall picture. We include several control variables like the traded volume, the length, the Bitcoin average return, Bitcoin trading volume, since there is a huge link, especially in the exchange, in the trading between pairs of stable coins and Bitcoins or other crypto assets. And that's it. Then we run the regression. So this is I think it's a very interesting picture, because as you can see, we just plot 2 things. One is the average half-life. As I said, is the, let's say, the capacity to dissipate a shock, and the other is the average monthly standard deviation. As you can see, in this quadrant here, we have most pseudo-currency board stable coins. So the one that are pegged 1-to-1 to the one that are having fiat collateral and are 100% reserves seems to be more stable, at least for these 2 dimensions. But we do, let's say, a horse race to see also for the other. So we have a couple of minutes more. I'm going to show you very quickly the results of the basic specification. So these are 3 sets of regression with and without and with the fixed effect. And here we have the 4 measures. So the deviation, the rolling deviation, the standard deviation, the rolling standard deviation, the deviation from the peg, and the monthly half-life. We immediately figured out that there was like two different reactions of these kind of stable coins. So for instance, for the prices we see for the returns, the average standard deviation, we find that there is a significant lower deviation, standard deviation for the currency board, but we do not observe anything for the central bank. And we see that the central bank are having a different behavior in terms of deviation from the peg and monthly half-life. Here, if the sign, the interpretation is that if the sign is negative, of course, they have a lower standard deviation. And here, if the sign is positive, they have a higher monthly absolute deviation and half-life. We do the same pretty much for the collateral. Collateral having negative sign here. And for gold collateral and algorithmic collateral, we have a positive sign. And also we have a negative sign for license audit. Putting together all the stuff, we end up with two sets of regression. The first one is on volatility and the second is on the half-life and deviation from the peg. So here we have as a baseline the central bank stablecoin with algorithmic collateral that are the one less stable in our framework. And we see that also combining all together, we find that the currency board with fiat collateral and license audit are the ones that are having less standard deviation, a lower standard deviation of returns, even considering the rolling standard deviation. We also do find that the presence of collateral and audit is also beneficial for a commercial bank like pseudo stable coins. Quickly, because I ran out of time, I've seen, these are the deviation from the peg, and it is also confirmed using as a baseline the previous one, so the currency board with fiat collateral, that we somehow have a positive effect, which is detrimental for the absolute deviation from the peg and the monthly half-life for the central bank with algorithmic collateral, with a couple of more interesting results for other type of collateral and type of stable coin. So to conclude quickly, what we can say also from our analysis is we have shown that the ones that are backed by the fiat currency, so they are linked to the financial safety net, are definitely more stable in terms of price and deviation from the peg. However, this kind of stable coins tends to be less disruptive for the existing international monetary system, since they are still linked to fiat currency. They are not really like Bitcoin or algorithmic or other kind of cryptocurrencies that are not linked to them. So the experimentation continues, but we have a lot of ongoing work going on from the central banks. These are just two examples of very recent report from the central bank digital currencies. One is from the digital euro from the European Central Bank to October, and another is joint work carried out by the BIS and a consortium of banks, central banks, from the central banks digital currencies, let's say best practice. I think it's all. Sorry, I've been late by a couple of minutes.
Thank you very much. Yes, you just taken 2 minutes. I didn't stop you before, but it was too interesting, your results. So, yes, the floor. Any question from the floor? You can. Yes, Ferdinando has one question. He can. Okay. Go ahead.
You say, Mario, that of course the fiat collateralized stablecoin were the one more able to keep their stability in a way. Is there any evidence in your studies about the news of being operated on fractional reserve to provide some instability or partial instability?
Actually, this is a good question, because this is the direction we are taking from the from the, let's say, the next release of the paper, or maybe another paper, because we know that there is a lot of things going on. There are a lot of, I would say, idiosyncratic events that are affecting the stability of the price of the stable coins, especially Tether and other kind of stable coins. And yes, our paper is more or less, I would say, an overall overview of what's going on. We want to have, let's say, a punchline that says, okay, these kind of stable coins are more stable than the other. But we are very well aware to the fact that there might be some, let's say, news and events and fraction and change in the. Also, there has been a huge change of blockchain Tether exchange apart from move from a blockchain to another, a huge amount of tokens, and this creates instability for a few days. So to come up to your answer, yes, we are aware to the fact, but so far we are not really exploiting the, let's say, the news part.
Other questions? How can we have our participant to raise the hands and then?
Well, there's no participant who has raised the hand so far.
Okay, so I can ask you a more philosophical question. Because reading and then also listening to your presentation, one question came to my mind. So if stable coin are more stable, more credible, if they are close to the current monetary system, so in the financial safety net, why do we need these stable coins? What is their purpose?
I mean, the point is the same as why do we need, let's say, a central bank digital currency first? And the point is that there are a lot of ways where this kind of, a lot of practical application where the stable coins makes, reduce a lot the transaction costs, especially for, let's say, cross-border transaction and so on. And also because so far, if you just think, I mean, I paid this morning my car insurance and I do with a bank, let's say a bank transfer, as I think all the people do right now. And I need to wait tomorrow or 2 days to have the transaction registered, and my policy like expires today. Okay, it's not a big deal because I'm covered for a month. But yes, so why do we need digital currency at first? Because we want to speed up this kind of part. And also, I got friends of mine that are paying like €1 for a bank transfer. So we want to have speed of for moving money back and forth, and also having reduced a lot the cost of cross-border transactions. So in this way, we have something that is a medium to exchange this this part. Of course, there are a lot of additional issues. I mean, I think that I'm not on purpose not discussing Libra and other like JP Morgan coins and so on. And we are doing that on purpose because these are not right now exchanged. So they are not really tokens. And I think that so far the phenomenon is very small. I mean, we're talking about really a tiny fraction of what's going on, but it's still increasing. My point is that if Facebook haven't done the, let's say, the move of announcing Libra and so on, I'm not sure whether this, talking about stable coins will be now here. Because Libra was another dimension of this kind of problem. Now we are still in a, let's say, in a second order magnitude of phenomena. Yeah, sorry.
So you raised the ball to Paolo that he's going to talk about Libra. So it's a perfect match.
Yes, exactly.
So,
thank you very
Paolo,
much.
It's your turn now. Thanks.
Yes, yes, for sure. I share my screen in a minute. Just tell me if you can see it, maybe. Okay.
Yes, we do.
Perfect. Thank you very much. So thank you very much for having invited me here. It's a pleasure. It's a great pleasure to talk to such a very good conference. I see very nice contributions. Just a few words on this work. I'm Paolo Pagnottoni, and I'm research fellow at the Department of Management, Economics and Industrial Engineering of the Politecnico di Milano. And this work is a joint work with Paolo Giudici and Thomas Edward Leach from the University of Pavia, in which they basically have a research unit, the FinTech Laboratory, which covers, among various domains applications, also the stablecoin and CBDC development. So just to give you an overview of what we are going to talk about, let's say that the previous presentation already gave some insights that I don't want to stress too much, but of course, many of you know that the stablecoin is a product that basically was born also in order to let's say, to overcome the inability of cryptocurrencies in serving as a medium of exchange, because they were firstly conceived to be medium of exchanges, then of course the speculative aspect took the advantage. So this is widely known. As well, it is widely known that cryptocurrencies, however, have low linkages with traditional financial markets and the real economy in general. For example, we might think about gold, we might think about bonds. Cryptocurrencies are very much unlinked from the dynamics of such financial instruments. So this, let's say, the whole background can enhance in some ways many economic aspects like financial inclusion, because we can, throughout stablecoin, throughout, for example, remittances, we can think about this as an example, we can develop a broader financial inclusion than that we have right now in the real world. However, this could, of course, also put some risks to the financial stability and integrity and to the monetary policy. We think about Libra, Facebook's Libra, of course, is a product that is issued by a private issuer, so it's not, of course, a central bank that owns the digital currency. So this, of course, puts some, let's say, troubles in sovereign governments because they do not have the hegemony of the currency anymore in this way. So if you think about the vast user base that Facebook has, which is estimated around 2.4 billion users per month, this is a huge amount of people using Facebook, which could potentially use Libra in order to conclude their transactions without passing through a third intermediary party. This is a bit of the background. Moreover, we can say that such crypto assets in general, but specifically stable coins, could be much more used during the last period, because we have, of course, the COVID-19 outbreak, which enhances in some ways the development of digital currencies, in the sense that we would like to exchange less physical money, at least physical money that we can in this period, because this could potentially, of course, spread the virus. So this is another motivation. I outlined here something that it's already told by the previous presentation by Mario. So there are several ways of constructing a stable coin, and I mean the main categories are those which are the tokenized funds, those that are claimed on a pool of collaterals that consist of funds, cash, electronic money, and so on. So, for example, Tether is the most capitalized stable coin nowadays, and it's back to the dollar, as we have already heard. But then there are also some other types of stable coins, like the off-ledger collateralized, which claim on pool of collaterals that are comprised of various assets, such as multiple currencies or T-bills. And then there are the on-ledger collateralized, which are instead claimed on collateral on the ledger. Then there are the algorithmic ones, which we have heard in the previous presentation as well, which are more constructed on a sort of match of the demand and offer between the stable coins. But what we are going to do is basically to address a point in the sense that we want to investigate if we have and we can construct a stable coin whose value is stable, really stable over time. How do we construct it? This is the first research question. Can it function as a global e-currency? So can a Libra in some ways function as a global e-currency? And then we investigate how do shocks in the underlying currencies that compose the stable coin affect the stability. So basically we aim to construct a stable coin which is based on a basket of currencies rather than a unique currency in order to achieve more stability. So we study how to do that. And in order to do that, we basically construct the dynamics of a single currency, in the sense that, of course, if you are familiar with exchange rates, you know that the exchange rate of one currency with respect to another is always expressed on a basis currency. So this makes it difficult in practice to, let's say, to examine the dynamics of a single currency, because you always will have USD to Euro, USD to Japanese yen, and so on. So in order to circumvent this problem, what we do is to use a technique which was proposed in a paper by Hovanov et al., which proposed basically the usage of the reduced normalized values in exchange, which are nothing else basically but the value of the single currency weighted by the geometric average of the other currencies comprised in the basket. So this is what you see at the denominator right here. So it's the single currency over the geometric average of the currency. This is normalized then with the same value but at T0 in order to have a single common starting point of the currencies, which will be 1, of course. So what does it mean? This allows you to examine the dynamics of a single currency, but delinking the currency itself from the dynamics of the others, so that you will have a unique value for US dollar, a unique value for Japanese yen, and so on. From that, what we do is to try to find some weights which are optimal in the sense that they stabilize as much as they can the stable coin, some weights to weight each of the single currencies. So how do we do that? This is translated into solving an optimal control problem, in which what we do is to minimize the variance of the basket-based stablecoin. So basically, we pool all of the currencies, we put basically their variances and covariances into the minimization problem in order to retrieve optimal weights, statistically optimal weights, in the sense that they minimize the variance, and therefore the concept behind it is to stabilize the stablecoin, because as much as we minimize the variance, the more that we minimize the variance, the more we stabilize the coin. So in order to then, let's say, in order to assess the shocks, how do shocks impact the dynamics of the stablecoin, we start from estimating a vector autoregressive model, which is illustrated here in the slide, and then to basically analyze impulse response functions and spillovers among the currencies comprised in the basket. This allows us to see which are the currencies which drive, in some ways, the price dynamics of the others, and therefore induce more spillover and more volatility, of course. So this is a bit of the aim of why we do that. These are some technical details about the estimations. I don't want to bother you very much about, because results are much more interesting. So let's go through the data. We analyzed the daily observations for the period 2002 end of 2019, and used these pairs of currencies, which is the US dollar, the Chinese yuan, the euro, Japanese yen, and Great Britain pound, in order to construct our basket-based stablecoin. This was the reason behind it was the declaration of Libra at that time about including such currencies in its basket-based stablecoin. Then we analyze also some of the emerging market currencies like the Indian naira, Mexican pesos, Nigerian naira, and the Philippine peso, in order to assess the stability of our stablecoin. Let's look at the results. We show our weights determined through the optimal control problem. And as we can see, the weights are quite even across all the currencies that we include in the basket, whereas we compare it to the IMF SDR weights, special drawing rights, which were already there, which overweight the dollar in some ways. But this is a bit of, let's say, a political reason, of course, behind this overweighting to the dollar. But what we see is that basically we achieve a currency that is labeled as a SAC, SAC in table 2, which exhibit very low correlation, as you can see from the last row and the last column, very low correlation with the other currencies. So this is very good, because it means that it is in some ways delinked from the dynamics of the other currencies, and therefore more resilient to shocks in other currencies. This is a graph that shows you the comparison with some emerging market currencies. And in this case, we can see that we divided the standard deviation of our stable coin and the other currencies reduced normalized values in different categories for the crisis period, pre-crisis period, and post-crisis period. And we see that although there are some period of time in which the stable coin does not beat the dollar in being stable, this is because of the specific periods of time, overall the stable coin achieves a very good stability. What we can see from here is the spillover, so what I showed you before. So the interconnectedness is a measure of interconnectedness of the currencies which are comprised in the basket. So the 5 currencies that I showed you before. This is telling us that over time, the spillover among currencies is decreasing, meaning that there is less contagion effect between the currencies composing the basket. But what we can see in, let's say, a more comprehensive picture is why. Here I depicted the net spillovers between the currencies. So this means how much each of the currency gives in terms of price information to other currencies. So what we see here is very interesting, because we see that the US dollar, which is the blue line, is almost overall dominating the spillover across currencies, apart from one event, which is in July 2005, in which the Chinese yuan was depegged by the dollar, and then after the Chinese central bank repegged it to the dollar some years after. In that day, this caused a huge spillover, which transmitted to, which shocked the whole currency market. But apart from that, the US dollar seems to dominate. What is even more interesting from my point of view is that this domination is gradually decreasing, in the sense that the US dollar is losing power during the latest period. And indeed, you can also see that there is a recatching of the Chinese yuan with respect to the dollar in dominating the price information stage within the currencies. So this is a bit what the picture tells you. Then just to give you a preview of some new results about the COVID period, we see that there are many differences during the COVID period, in the sense that there is a huge shock caused, of course, by COVID-19, which spread all over the market, and some currencies, like for example the US dollar, loses a bit its domain, let's say. This is the main takeout message. Of course, there are also even much more, but you can also go to the paper. Of course, I would be glad of discussing in other occasions also this. What we depict also is the spillover network, because you can derive from this measure a network that tells you how much of the spillover in volatility is exchanged across currencies. And the spillover network says clearly that the US dollar is the one dominating the other currencies, followed by the Chinese yuan and the Great Britain pound to a lesser extent. However, the Japanese yuan and—
1 minute left, Paolo.
Okay, thank you. Thank you. Japanese yen and euro are the most affected. I'm almost done. It's just the last slide. This is just to tell you that this equilibrium is, however, affected by the COVID-19, because here you see the pre-COVID period and the post-COVID period, in which the situation seems to be reverted, in the sense that currencies of which the country was affected before from the COVID-19, there are those that give the spillover during this latest period. So this is very interesting and comes to some conclusions. So what we did is to construct the basket-based stablecoin and to assess spillover into the basket of currencies. What we see is that USD mostly drives spillovers. However, this is also losing its leadership over the latest period of time. I'm glad to hear about any question, and thank you, and sorry for the slight delay.
No, thank you. So your paper is a perfect match with the paper by Mario and Sebastian. They show that the stable coin is more stable if it is pegged to a currency, and you have demonstrated that it's better to have a basket of currency. Of course, Ferdinando has a question, and I leave him the floor.
I'm sorry, I hope I'm not intrusive, but I see
No,
that
no,
these are not raising their hands, I raise mine. And I'm wondering if I got it right from your presentation, and I will surely devote more time into reading the paper and going deeper into it. But the idea of stability you are advocating is kind of minimizing volatility.
Yes.
Which doesn't mean that the purchasing power is stable in time, isn't it? And that is kind of intrinsic to the fact that being backed by fiat currencies, or that is as much as inflationary as those fiat currencies will be. Am I right, or am I missing something?
Yes, yes. I mean, of course, the algorithm, I mean, you are totally right, and thank you for the question, because it's a very interesting point, I think. What I believe is that, however, the algorithm should take into account for inflationary problem, in the sense that if you have a great degree of inflation, to some extent, this translates also into variability of one of the single currencies. So the variability of one of the single currencies boosts in such a way that the algorithm, which is based basically more or less on a Markowitz allocation, just to give an idea, this for sure will let out the currency which is more variable, so giving it let's say smaller weight. This should circumvent the problem of high inflation or a high variability in general in one of the currencies. So I think this could be but could be also a good point to investigate more, for sure.
Thank you. And if anyone is willing to ask a question, please either raise your hand or write in the chat, and I read the questions. My question goes to I understand the rationale for those who will make the remittances to have such a stable coin, but then those who receive these tokens, how difficult could be to translate, to obtain their own currency? So you have set up a nice way to have a stable coin, and then there is another problem with the currency at home to organize an exchange way.
Of course, I think this is a very good point because it's a practical point. So this is what we should search about many times. And I tell you that Libra is in the latest report that they have released. Basically, they aim not to substitute the traditional currencies, but to integrate. So they aim to do a basket-based stablecoin, which is claimed on different currencies, but then also to have each single currency into a digital coin as well, in order to more easily exchange between the basket-based and the single one, which, as you say, it's however unavoidable in some sense, because of course each of us will need euro in some sense, or US dollar. So this is a very good point, and Libra thought about it as well.
But in this way, we have higher costs, financial.
Well, this could in some ways increase the transaction costs. Exactly. However, should reduce. It's a trade-off between transaction costs and volatility risk. So, of course, this, however, let's say, mitigates the volatility risk of the single currency, which in certain circumstances, I think it's a good way off.
Okay, thank you. If there are no other questions from the floor, I leave to Ferdinando the floor, and we move from stablecoin to Bitcoin. Ferdinando, we see your paper, but we do not hear you.
Yes, okay.
Okay. Yeah.
Sorry, multiple screen and difficulties to find the microphone button. Okay, so in a way, my question to Paolo was kind of instrumental in what I was going to add with my contribution to this session, which is about, well, the title is at least the cryptocurrency frontier in monetary engineering. The idea is starting from my original contribution in 2014, which is known as Hayek money, where I advocated a cryptocurrency monetary standard of elastic, non-discretionary supply. As a matter of fact, a price stability paradigm with respect to a given reference basket. In that old paper of mine, I noticed that Bitcoin reached the price of $1 in April 2011 and $500 in March 2014. So it experienced a 500 times increase in its demand relative to the USD dollar. And now, if in March 2014, when there were about 12 million Bitcoin in circulation, one could inflate their number 500 times, Well, on that date, it would have been completely equivalent to own one Bitcoin worth $500 or 500, let's call them rebased Bitcoins, each one worth $1. Of course, such a rebased Bitcoin will be implicitly adopting the US Consumer Price Index or the US monetary policy, so 6% inflation in 3 years, according to the plan of 2% inflation per year. But let's remember that 2% inflation per year means that our saving lose 1/3 of their purchasing power in 20 years. So it's an hidden tax, which might not look as aggressive at face value, but it is in time. And so instead, let's avoid the USD monetary policy and let's go for trying to achieve price stability with respect to a basket of Brent oil and wheat. Such a basket was priced during that period of time $400. And of course, it was worth 400 Bitcoin in 2011, but 3 years later, you could buy that basket with few cents of Bitcoin. Instead, if you switch to rebased Bitcoin, of course, you could make the price flat to whatever level, in this case, 10 rebased Bitcoin. And such a rebased Bitcoin, if you will normalize its volatility, in order to compare it with the USD euro volatility, you will see that this will make the rebased Bitcoin a very regular and well-behaved currency comparable to the euro one. Rebasing Bitcoin, well, of course, that was just an hypothesis used for the sake of discussion, basically to leverage the Bitcoin historic price time series. Bitcoin is good as it is the digital equivalent of gold, more a cryptocurrency, more a crypto commodity than a cryptocurrency. The results that were achieved with this first simplistic implementation of what was called Hayek money, with reference to the economic Nobel Prize laureate Friedrich August von Hayek, which was advocating which was against the monopoly of money by government. Well, the result of the first simplistic implementation was price stability. And so all of a sudden, salaries, mortgages, and forward payment were possible. But it had its own problem. Namely, the number of coins in a wallet will change without any real cash flow. So even if the purchasing power of one coin will be stable, the purchasing power of whatever wallet will not be stable because it will see its number of coins changing in time. Moreover, coins will still have speculative investment appeal, because if you don't spend them and the coin does appreciate, you will find in your wallet those coins be multiplied, increase in quantity. And so to buy pizza with coins, like people did in 2010 with Bitcoins, will still remain something not very smart. And so such a coin will still enjoy very limited transaction usage. There were early improvements proposed and early implementation, namely Massimo Morini suggested to segregate coins in different investment or saving wallets, the first one being rebalanced and the second one being non-rebalanced, but he failed to clarify how to avoid switching between the two regimes in inflationary or deflationary scenarios. And Robert Sams pushed the idea further because he was the first one to realize that two non-fungible different assets were needed. And he called them coins and seigniorage shares. But Robert failed to clarify how to avoid exhausting one asset or the other in inflationary or deflationary scenarios. So how to reach the equilibrium was not that clear in his proposal. The early implementation, well, they are not worth to be really discussed. BitShare, Nubits, DAI, Bancor, they have all been naive, wrong, and or centralized. Consequently, they have failed or faded into insignificance. Tether has been so far the only stable coin successfully targeting USD parity, And the crucial part has been that it was relying on reserves backing the coin, not just algorithms, and even if it is suspected to operate on a fractional reserve. So the idea, which has been working on since 2014 and has been gradually refining across the years, is what I call the dual asset ledger. So to split transactional and speculative money demand with two non-fungible assets. So blockchain technology will track ownership and transaction for both, and so we talk about a dual asset ledger. And there also will be a reserve asset bank, which will act as issuer, issuing both stable transactional coins and unstable speculative shares. And the market, of course, will assign respective prices to coins and shares. The monetary policy target will be to make the coin stable in purchasing power with respect to a given reference basket. So the coin will be pegged to parity, where parity is parity with 1 unit of the reference basket. Even better, the coin will be allowed to float in a corridor, let's say just as an example, between 0.95 and 1.05. Coins, of course, must not be inflated or deflated arbitrarily. If one reached the goal of having the coin to be at par, basically the coins will lose any speculative appeal. So their money velocity will increase, and as such will support an increase in transaction volume according to the usual relation between money supply, velocity of money, price level, and the aggregate real value of transactions. What will be the role of this reserve asset bank? Well, the reserve asset bank will need reserve asset to enforce the coin price corridor by market operations. So the reserve asset bank will be responsible of enforcing a floor on the coin value, and that can be achieved if existing coins are always bought and then burned, destroyed, or removed at the price of 0.95 using reserves. And the reserve asset bank will use such reserve until they are completely depleted in a very automated, non-discretionary way. And since existing coins are always bought by the reserve asset bank at 0.95, it will be impossible for the market to have the price of the coin below that floor. The ceiling enforcement is a mirror of that. Newly minted coins will be always available for sale at 1.05, and so this will avoid the price of the coin to ever go above 1.05. Of course, issuing newly minted coins, the reserve asset bank will be increasing its reserves. This enforcement, let me stress this, should be algorithmically deterministic, not discretionary at all. The reserve asset bank would basically do its own IPO, raising bitcoins as reserve asset and issuing in return coins and shares. At any moment, the liability, that is the obligation to redeem the coins, all the outstanding coins at the price of 0.95, this liability should be less than the assets. Surely at IPO and hopefully at every later time. The market, again, let's repeat that, will assign prices independently from any consideration. But the monetary base being backed by reserve asset, at equilibrium, it should hold the number of coin times the price of the coin, plus the number of shares times the price of the share should be equal to the reserve asset. Those shares are, in a way, senior shares, in the sense that shareholders will oversee the reference basket maintenance. Well, this will be only fair. After all, that is their coin. They back the coin with their own capital, and so they are entitled to be the reference asset bank governor in a way. The share price will be free to float, but since share value is asset minus liability. At equilibrium, there is a clear relation between the price of the share, the reserve asset, and the market evaluation of a coin. Now, the shareholders, in a way, they absorb monetary policy's profits and losses, shielding the coin holders from any kind of volatility. And there will be no compelling reason to ever burn or destroy existing shares. Let's focus on what happens when the coin is in demand and reach the upper ceiling of 1.5. Of course, this generates profits from the shareholders. That's why those are senior shares, because in order to avoid the price going above 1.5, newly minted coins will be available for sale at 1.5. And for every new minted coin, the reserve assets will increase by 1.5. The coin liability will increase by 0.95, and there will be a positive net effect for shareholders. So senior shares really enjoy senior revenues. In the opposite sad scenario of the coin not being in demand or actually being sold, being sold on the market, the floor enforcement, let's remember, means that existing coin will always be bought at 0.95 using reserves. And if the selling pressure does not stop, well, of course, if the assets are less than the liabilities, the coin is dead, the bank's defaults, and the price of the share collapses to zero. But if the assets are greater than the liabilities, then the coin will be still dead, but the bank will not default, and the share price will be greater than zero. In this scenario, there will be no interest for this stable coin, and shares will be now strictly equivalent to the Bitcoins they are entitled to. In a way, in this scheme, we are leveraging Bitcoin as reserve asset. Bitcoin being the first and most successful instance of an intrinsic scarce digital asset, it's only natural that it can play the role of digital gold. When used as a reserve asset, its qualities are magnified and its limits are lessened, because there will be no more need for scaling to huge number of transactions or supporting economically inefficient micropayments or lowering confirmation time. All of this will be demanded to the stable coin. The reserve asset IPO will raise Bitcoins and it will issue senior shares and stable coins instead. As a matter of fact, even Olaf Finney, the worldwide known cryptographer, in 2010 was already seeing the ultimate fate of Bitcoin to serve as reserve currency, and was writing about Bitcoin-baked banks. The last point in this scheme will be about transaction validation, because Bitcoin generation block generation in Bitcoin is rewarded with issuance of new coins, but in this case, block generation will be rewarded with issuance of new shares, 1 share per block. Instead of the hardware and electric power cost of the computational expensive proof of work, which is a characteristic of Bitcoin, in this case, Bitcoin themselves are irrevocably paid to the reserve asset bank by the validating nodes in what I call proof of payment. In a way, the chances of being appointed for the next block generation are proportional to the overall submitted payments, that is, to the accumulated proof of payment. When a network node is picked up for block generation, its proof of payment resets to 0, other nodes are not affected. That is, if a node is not picked up for block generation, its payments are not lost or discarded. They are never reimbursed. Nonetheless, they are valid for the next block generation lottery. And since the price of the share has an equilibrium level, that should be the maximum price a rational agent is always willing to commit as payment in order to validate the next block. And so we will have a confirmation. A byproduct of the block generation lottery will be to provide reliable low bound estimation for the share price. Please note that existing shareholders are not really diluted because for the issuance of each new share, the reserve asset increase prepared accordingly. Actually,
Ferdinando, 1 minute left.
Yes, actually they increase even more than that because all proof of payment cash flows are immediately collected and then rewarded in the future. So the bibliography that this work is based to is available in the paper, but let me summarize the issue. So with Hayek money, price stability can be achieved with a new generation of cryptocurrencies. We will have multiple cryptocurrencies competing with different monetary policy definition and reference basket choices. The dual asset ledger proposal can be used to decouple speculative money from transactional money, and Bitcoin payment can be used as economically expensive proof of payment instead of the computationally expensive proof of work. And this represents, in my opinion, the frontier of monetary engineering because it is about entrepreneurial monetary enterprise. Investors risk their capital and gain only if the coin is useful and successful. Dual asset ledger fiduciary implementation are already possible, but reliable technology for a decentralized automated implementation is probably not available yet. And this scenario will prove that Bitcoin as reserve asset can bootstrap new monetary system. That is, Bitcoin, the digital equivalent of gold, could be as relevant as physical gold for the history of civilization, the future of money and finance. And we might see private money competing with legal tender money, and that is the separation of money and state. Of course, if we remember how difficult it was to separate the church from the state, we can figure out how difficult it will be to separate the money from the state. Thank you for your attention.
Thank you for your presentation, and we will need a revolution to have this separation between money and state probably. And of course, if there are questions, it is the time to raise your hands or write on the chat while I'm asking Ferdinando, what is the role of banking in this scenario that you have depicted? What banks would do in this different scenario? Of course, different.
Yeah, they will do what Hayek was dreaming of, basically issuing their own private monies and competing among themselves on the most stable one in purchasing power terms. Of course, regulators have proved that they do not like private money at all. So I will not look to the bank as we know it today to be the active agents of this proposal, but basically what we have seen as permissionless innovation. I mean, we should not be scared by permissionless innovation. I mean, internet has not been designed by a consortium of telecommunication companies. The email has not been designed by a consortium of postal offices. It might be the case that the new money and the new payment network might be designed not by the bank as we know them today.
What is the main difference between this scenario that you are depicting and 1800 private monies that were circulating in Italy? You know that we have Bank of Napoli money and the different main banks which were issuing their own money, and at the very end we ended up with Bank of Italy becoming a central bank and one currency for Italy.
Well, on one end, we could be approaching exactly what the historical trajectory you have depicted will suggest that today we do need supranational global money because we are more and more a global economy, and this is what is lacking. And there might be competition between different central banks on providing the de facto reference asset, but let's be fair, the US dollar has been so far enjoying some unfair advantage into being the reserve asset worldwide. And I think that scenario, that competition will continue, but we'll just see new players. And The key point is that everybody will be exercising their own judgment into their own asset liability management and picking up the money which is more adapt to their own needs. We could imagine an oil coin having price stability and being one-to-one to the oil barrel, okay? And of course, if a green economy will provide alternative to oil, that oil will not be interesting anymore, and that coin will fail. We are not talking about coin that cannot fail. We are talking about the ability of people to design the money which is more adapt to their own needs. Thank you for your attention. I will leave the floor to other ones.
There is another question from the floor.
Yeah.
What about privacy? Would it be not be lost when banks take charge?
Well, it depends. I mean, the the devil is in details, of course, and so privacy is more about the technical details of the implementation. Whenever we talk about central bank digital currency, well, that will not be a currency. That will not be, oh well, that will not be cash. That will be some kind of electronic money, because the common judgment, it's about anonymity in financial transaction be something bad. I mean, we have totalitarian regimes in the region of the world, or even in Europe in the past. So I think we should pay much more attention to privacy when designing new payment system. But my confidence is in the market competition. If market forces will be able to compete, the better solution will prevail.
Okay, thanks for this big faith in the market. And we go to Alexander.
Okay, hello.
Okay, hello.
Let me try to
share your screen. Yes,
yes,
please.
exactly.
And
okay.
we will talk about crypto-covered interest parity deviations.
Yes, exactly. Okay, so this is joint work with Friedrich-Carl Franz. We are from Goethe University in Frankfurt. And as you said, this paper is about crypto-covered interest rate parity deviations. And most of you will probably be familiar with this already, but let me just go through the outline here. So we're going to show you what CIP is, covered interest rate parity. We show you the data that we use, and eventually there will also be some robustness checks, and then I'm very happy to receive some comments on the work that we did. So what's the motivation really? So as you know, the crypto space has evolved in recent years, and now you can not only buy and sell Bitcoin or other cryptocurrencies, but you can also trade futures and options, and there's also a highly active credit market. So we apply basically a concept from classical finance theory on the cryptocurrency market. So this concept, crypto covered interest rate parity condition, is basically an arbitrage condition between futures or forwards and the spot price as well as interest rates. And as Borio says in his paper from 2016, it's basically the closest thing to a physical law that you could have in international finance. So this actually should hold irrespective of the asset or the currency that you're looking at. So what we find, and you can see this in this figure, that there are huge deviations from covered interest rate parity until the first quarter of 2018. And the deviations that we find in absolute terms are up to 15%. And this is very large, especially if you compare this to the fiat world. So let me just show you this paper from Du and co-authors. So they look at CIP deviations after the great financial crisis. And I mean, back in the day before the financial crisis, CIP basically always held. And then during the financial crisis, of course, there were some deviations, but those never disappeared. So it was pretty persistent. And I think the average for the US dollar, for instance, would be about 32 basis points. That still persists. But again, if you compare this to the 15% that we found in the crypto space, that's pretty large. So we were actually looking for the reason why this CIP decreased so much during the recent years, and we found two events which we analyzed and wanted to find out which one of those was actually the main driver why CIP deviations disappeared so much. And on the one hand, we were looking at the launch of the CME future in December 2017. And then we were looking at the entry of high-frequency trading firms to the cryptocurrency market in March 2018. And I will show you later with our regressions that we try to attribute this decrease in CIP deviations not to the CME future, but to the entrance of high-frequency traders. And what you can also see in this graph, let me say this already, so we plotted in blue the CIP deviations, but we also plotted this adjusted CIP deviation because we, as you can see, there's still some deviations after the entry of high-frequency traders, but we show in our analysis that this is mainly due to the counterparty risk of cryptocurrency trading platforms. And if you account for this risk, you actually see that CIP deviations have decreased by a lot. So what's the contribution of this paper? Well, we think it's threefold. So on the one hand, we analyzed covered interest rate parity in the crypto space, which we think has not been done yet. But please correct me if I'm wrong, and please point me to other papers that you might have heard about. Then we try to identify the structural break that you could see in the figure. And we attribute this impact to the high frequency arbitrageurs. And the interesting finding that we also have is that we compare the Bitcoin US dollar market and the Litecoin US dollar market, and we actually find that the effect for the Litecoin market was much stronger than for the Bitcoin market. So what I'm going to do in the next two slides is to show you the potential drivers of CIP deviations that we identified, then test what effect the CME launch had on the cryptocurrency market. And then I will show you how we relate these remaining deviations to the counterparty risk, which we call Bitfinex premium. So the literature review, I'm not going to spend too much time on this. Covered interest rate parity, of course, has been studied a lot, and there are some people who attribute funding constraints as the source for these deviations. Other people say that it's regulatory constraints. And we basically show that once market efficiency arises, for instance, from high-frequency traders, then often counterparty risk can be the reason why CIP still persists. And there is some other literature that more closely relates to how crypto markets and financial instruments have evolved over time. There's also this paper by Makarov and Shoa, which say that there are large cross-exchange arbitrage profits, and their sample period ends exactly in March 2018. So I think there is some room for further research. If you would look at the period after March 2018, which we identified as this entry of high-frequency traders. So as I will also show in a robustness check later on, you can see that those arbitrage profits have largely disappeared. And of course, there's this entire literature on high-frequency traders and what they do and how they affect the market efficiency. So what's the theory here? Okay, so covered interest rate parity is basically a fundamental law, and it allows for profits through arbitrage, and any arbitrageur would basically exploit this until the deviation would not exist anymore. So in this equation here, you can basically see that it's all in natural log terms. So the basis, which is the log difference between the future and the spot rate, should roughly equal the interest rate differential between two currencies. And by simply rearranging this equation, you can actually calculate the cross-currency basis, which then is the CIP deviation. And this is basically the calculation which our analysis is based on. So let me briefly say something about the data. So we try to mimic the profit function of an arbitrageur. So we concentrate on sourcing the data from basically just two sources. So we take the spot and interest rates from Bitfinex, where we have a large credit and spot trading market. And because we also need data on the futures, we take this from OKEX, because there was basically the first exchange that introduced a future that was traded with high volume. So this is pretty reliable data, and it's also available on a daily frequency. We also use crypto compare to later on construct this Bitfinex premium, and for the regression about drivers of CIP deviations, we also take some data from ICON, which is the VIX and the TED spread. In figure 3, you can see this the mechanics of a trading strategy that would exploit some CIP deviation. So if you would realize that it's actually cheaper to exchange on the spot market, invest in Bitcoin, for instance, and then trade it back via the futures market, then you would choose not to invest in the US dollar market, but basically invest in Bitcoin and change it back. So this should always hold, and as soon as this relation does not hold, you could exploit it by arbitrage profits. So we calculate this trading strategy, and below you can basically see 2 graphs which depict the profits of this trading strategy, and this strategy would exploit every deviation, so irrespective of the size. So of course the Sharpe ratio would improve a bit if you only trade on the larger deviations. But you can basically see that before the entrance of those high frequency traders, you can generate a lot of profits, especially, for instance, if you look at the second sub figure, you see that the profits increase by a lot until the entry of the high frequency traders, and then it's basically a flat profit function, because and we attribute this to the high frequency traders exploiting all deviations. Of course, you would also need to account for some trading fees. That's why we depict the gross and the net. But I think the story is pretty much the same. So what we first of all do is we thought about this launch of the CME future, and we decided, okay, maybe that could have been the driving force for those CIP deviations to disappear. And we created this difference in differences design, because we said, okay, we have a nice treatment group which is Bitcoin, and we also have a control group which is Litecoin, because this CME future is only available for Bitcoin. So in the equation, you can basically see the setup of our regression design, and we would get some coefficients for the effect on Bitcoin, the effect in the post period, and then basically this effect on Bitcoin relative to the control group Litecoin. And for this, of course, you need to think about the parallel trends assumption. And in figure 5, I depict some proxies for market efficiency. So that's on the one hand CIP deviations, and on the other hand this bid-ask spread proxy. And as you can see, while for Litecoin the inefficiencies are much larger, you can see how they disappear after this entry of the high frequency traders, which is the second vertical line that you can see. Okay, so what did we get from our difference in differences analysis? If we look at this CME future launch in December 2017, we see that after the event, the CIP deviations decreased by a lot. So not only did they decrease for Bitcoin, of course, but in the post period they decreased. But the interesting thing here is this interaction term, right? So how did it behave for Bitcoin relative to the control group? And here we see that actually CIP deviations for Bitcoin did not decrease as much as for Litecoin. And so this effect for Litecoin is stronger, which is in a way puzzling, because you have this idiosyncratic risk of Litecoin, which you cannot hedge away by trading this future on the CME. So from this, we basically conclude that simply because it can't be true by logic that this CME future was not the driving force, and we rather want to concentrate on the entry of the high frequency traders. But to again rule out that it was the CME future, we thought about another difference in differences design, which should tell us a little bit more about the effect of the CME future. So what we did was we were trying to compare the trading and non-trading hours. So the thing about the CME future basically is that it's only traded during the week. But as you know, all cryptocurrency markets trade throughout every day of the week. So we can compare trading hours and non-trading hours of the CME future. And as you can see in column 1, we basically found that for CRP deviation, there's no significant difference between trading and non-trading hours. And again, if you could use the CME future to arbitrage away those covered interest rate parity deviations, then we should actually expect there to be a difference in this coefficient. And since this is not the case, we turn to the next event, which we identified as the driving force. So for this, we simply perform a panel regression about the Jane Street market entry. So from SEC documents, we know that in March 2018, Jane Street entered the cryptocurrency market, and we also know that flow traders followed in July. So we take as an event, in this case, the March 2018, and we will have a look how CRP deviations behaved before the event and after the event. But since we do not have a control group anymore, as we must believe that Litecoin was just affected as Bitcoin by the market entry, we performed this panel regression. And as you can see in the highlighted boxes here, we again find that in the post-period, CRP deviations decreased by a lot. But we again find this positive coefficient for Bitcoin in the post-period, which means that for Litecoin, the effect was a bit more pronounced, a bit stronger. And this is actually what we take as evidence for the fact that high-frequency traders affect the illiquid market more than the more liquid market in this case. We also include some control variables. And by including those controls, we still achieve the same objective and can verify that CRP deviations have decreased in the post-period. And this is not only true for the CRP deviation itself, but this is also true for the other proxies of market efficiency, such as half-life and volatility in this case, but also the spread measure and profits for the arbitrage strategy also decreased in the post-period. So what are the remaining drivers of CRP deviations that I talked about in the beginning? Because you can still, in figure 1, see some minor deviations afterwards. So on the one hand, we believe that short sale constraints might be a reason. So if I go back to the graph from before, we can see that the green line, which basically shows us the profits for a strategy that trades if the basis is smaller than 0. So we still see some profits here, and that's basically due to the fact that in this case you would have to buy the future but sell the spot. So you would go short on the spot market, and that might be hard if you have if you have some inefficient market where the future volume is a lot larger than the spot volume. So this is one thing that we identify as a driver of remaining CRP deviations after the high-frequency trader entry, but we also look at this default risk of Bitfinex. So as you know, there were some allegations against Bitfinex about the manipulation of Tether, for instance, and this has caused the spot price of Bitcoin to be higher on Bitfinex compared to other exchanges. So what we do is we derive this condition for basically the default risk of Bitfinex, and then compare the price of the Bitfinex spot versus the crypto compare spot index, and we call this the Bitfinex premium. And as you can see, the higher the Bitfinex premium, the larger the CRP deviations. And if you account for the Bitfinex premium in the CRP deviation, then you arrive at the first figure that I showed you, where you can see that CRP deviations have actually disappeared if you account for this counterparty risk. What we also do is we do some robustness checks. So instead of only considering Litecoin, we also look at Ethereum. So there's also a future traded on OKEx for Ethereum.
Alexander, 1 minute left.
Oh, sorry. Okay, well, then I have to speed up a little bit. So one robustness check where we replace Litecoin by Ethereum, but the results are qualitatively the same. We also test for uncovered interest rate parity, and we can also see that there are large deviations But compared to CIP, which is bound by arbitrage, we cannot really find that UIP deviations have disappeared by a lot after the high frequency trader entry. And we also checked for triangular arbitrage, and this again confirms that after the high frequency trader entry, you can see that the gains you would have from such an arbitrage trade largely disappear. So let me conclude. We find these large CIP deviations until March 2018, and we attribute this to those sophisticated arbitrageurs entering the market. And we also find that these arbitrageurs had a stronger effect on the efficiency of the less liquid market. And well, there's a lot of future research, of course, that you could do. So think about counterparty risk on other exchanges, and well, also test for the introduction of physically settled crypto futures, which you had by, I think, by BACT in the recent month. Okay, thank you very much.
Thank you, Alexander. And I leave the floor to questions. And I have a clarification in mind because you said that the introduction of the Chicago Mercantile Exchange did not have a significant impact or effect on the overall design of the currency interest parity. How do you explain this? Is this a problem of market microstructure in general, or the specific market microstructure of the Chicago Mercantile Exchange? Or it is because the future, maybe not, because you have also studied another future market, that the future with its future market with a stricter rule is not suitable for this kind of market, which needs, with kind of asset which need unregulated market to be negotiated.
Yeah, okay, very good question. So I think what we what I maybe didn't stress enough here is that if you trade on the Chicago Mercantile Exchange, you're basically still in this like traditional financial world, while in the cryptocurrency space, you can trade all other sorts of things. And I mean, there are simply different players active in both markets, right? So when we looked at this chart of the CIP deviations in the first place, we thought, okay, there's this like huge decrease around this time, and the CME future was kind of the thing that was discussed a lot. So maybe that must be the reason. So we did the difference in differences regression, and we found these significant coefficients, but they simply logically didn't make too much sense, right? Because you had this stronger effect for Litecoin, although Litecoin could not have been affected at all by this because the future only trades on Bitcoin. So we thought there must be some other reason, and that's why we looked at the entry of the high frequency traders. The thing is that if you trade, like if you're interested in Litecoin, want to trade Litecoin, you have to go to the crypto space, and the CME future doesn't really help you at all with this because there is still this idiosyncratic risk of Litecoin. And what I should also say, I guess, in this context is that the volume of the CME future simply never picked up really. So it was never as large as future contracts in the crypto space. And in our paper, we also have this this citation of a trader who said, okay, the CME future is basically useless for us because you need a lot of collateral. Bitcoin is trading 24/7, but this future only trades during the week, and we can get a margin call, and then our entire trade goes to hell, basically. So yeah, I think that's what one should say about this CME future. Yeah.
Thank you. I don't see any question from the chat or any raised hand, so I can leave the floor to Martin. Please show your screen, and we'll have a look at the fixed cost, which are an important part of the negotiation in any market.
Thank you. I hope you can see my slides.
Yes, absolutely.
Awesome. So first, I would like to thank the organizers for the wonderful conference. It's been a real pleasure so far seeing all the presentations and all the thought-provoking presentations that I've seen today. Today I'm here to present a joint project with Rod Garrett from UCSB I work at the Bank of Canada, and the views that I represent today, they do not necessarily reflect official positions of the Bank of Canada. So the project that I would like to present today is the paper Why Fixed Costs Matter for Proof of Work-Based Cryptocurrencies. And basically this presentation, it's basically about one thing that we often kind of presume when we're talking about cryptocurrencies which is basically the finality of payments. The idea that when you make a payment and when you've received a certain cryptocurrency, that you really received it and you don't have to worry about that payment is going to be reversed in the future. In reality, that is not necessarily the case. So there are, for example, there's the risk of double spending attacks. And this is a very real risk. So for example, there's this article in May 2018 about a Bitcoin spin-off. So we're not talking about Bitcoin, but a Bitcoin spin-off called Bitcoin Gold, which got hacked in a rare 51% attack. And basically what happened is some actor or actors, they sent Bitcoin Gold to exchanges. Then the exchange thought they had received these Bitcoin Gold coins, but then later these transactions were reversed in a 51% attack. So suddenly there was a loss. Suddenly those exchanges faced a loss. So just a little bit of history about Bitcoin Gold. So Bitcoin Gold was born as a hard fork of the Bitcoin blockchain in October 2017. And one of the things that it aimed to do was it tried to achieve a higher level of resilience through a more decentralized mining structure. So one of the points of critique of Bitcoin was that that mining had become much more centralized than they thought it was efficient to be. Part of the reason for that centralization is basically to mine Bitcoin nowadays, you need very specialized equipment. And basically what they did is they adopted an algorithm, a proof of work algorithm, that basically disabled the use of specialized equipment for mining operations by basically requiring very memory intensive computations. Now, what happened only 2 quarters later is basically there were several 51% attacks in May, and the attackers were basically able to double spend approximately an estimated $80 million in terms of Bitcoin Gold. And that also led to loss of confidence in Bitcoin Gold and a decline in the exchange rate. And at the time when we wrote the paper, the Bitcoin exchange rate had declined to less than 1/6 of what it had been at the time of the attack, and the number of transactions declined to less than 1/3. So here is kind of a quick chart of the Bitcoin exchange rate around the time of the attack. So on the horizontal axis, you observe the number of days, and basically what you see from this chart is regardless of whether you look at the price of Bitcoin Gold in terms of Bitcoin or in terms of US dollars, in both cases there was a decline. And this has not been the only double spending attack that has occurred. So basically, since then, there have been many double spending attacks on many different small cryptocurrencies. So one of the questions that we want to ask in this paper is why was Bitcoin Gold subject to a 51% attack that was successful? Well, Bitcoin itself has not been. And the typical answer that people have in their mind when they see this question is, well, there's nothing as big as a Bitcoin network. Nothing has as much computational power in terms of solving that particular hash function. So nothing in the world is big enough to perform a 51% attack. But that cannot not be the full answer to this question. And the reason is very simple. Well, the Bitcoin network, it consists of many individual actors. So in principle, there could be a coalition of these individual actors, which are already organized in mining pools, who in principle, if it was in their best self-interest, if it were profitable to them, could do a 51% attack on Bitcoin. So why is that not happening? And what we learned from the research today is that, well, understanding the role of fixed cost in cryptocurrency mining is crucial to answer this question. So, of course, there's a broader literature about Bitcoin mining and double spending attacks. And most of these models, they look at the variable cost of mining, for example, the electricity cost, but they do not look at the fixed costs that are involved with setting up the mining operations. Now, there are two notable examples. One is a paper by Eric Budish in 2018, and he does not actually formally model fixed cost, but he gives a verbal discussion of how his results could change if he were to account for fixed cost. And basically what our paper shows is that many of his intuitions are correct when you formalize it in a model. And secondly, there's a paper by Pratt and Walter, and they discuss the entry decision by Bitcoin miners in the presence of fixed cost. And then they actually estimate the fractional fixed cost. And basically their estimates suggest that about 2/3 of the cost of Bitcoin miners consists of fixed cost and only 1/3 consists of variable cost. So to conclude, fixed costs, they are a considerable part of the cost to miners. However, in their paper, they don't really consider the implications for double spending attacks. And in this paper, we're going to ask the question, what is the impact of fixed cost on the potential feasibility of profitable double spending attacks? So basically, we're going to incorporate the fixed cost of setting up a mining operation in a model for double spending attacks, and basically some quick theoretical results. Well, first, if we just look at a model where there are variable costs, well, in economics, there's this very easy model. If you have free entry, then what will happen in equilibrium is that the market parties, they will earn zero income in equilibrium because that's what competition does. And whenever they earn positive income, there will be new market entrants. So if you only model variable cost, basically what happens is miners, they earn zero income in equilibrium. And the consequence is that when the exchange rate drops of a cryptocurrency, that miners do not really lose anything because they were earning zero income in the first place. Perhaps some of them will exit the market, so there will be no downward rigidity. If the exchange rate goes down by 1%, then you would expect that the decline in mining power would be exactly proportional based on a model where there are only variable costs. And this is very simple economics. But as a consequence, the cost to miners to participate in a double spending attack, they are rather low because they don't have much to lose. The only thing they might lose is kind of the coins that they mine during the attack. They might have to sell them at a lower exchange rate after the attack. But they don't lose a lot in terms of future earnings. And this is different when you consider fixed costs. So basically what happens in equilibrium, if you account for fixed costs, is miners, they earn a positive income in equilibrium. Basically, they exactly earn their cost of capital, the cost of replacing their hardware. So they have something to lose. Of course, in equilibrium, because of free entry, you would say the economic profits would be zero if you account for the fact that they have to invest in the hardware and basically to earn back their investment. However, they still make a positive income, which equals the cost of capital. So if the exchange rate drops, basically miners will lose because now their income will be lower than it was before. Basically, they will not be able to fully earn back their investment. So what will happen in equilibrium is that miners, mining power will exhibit downward rigidity because as soon as the exchange, if you have made this investment and as soon as the exchange rate drops, if you're still earning a positive margin, you will continue mining because you want to earn back at least part of your investment. Only if the exchange rate were to drop really far, then you would consider quitting mining. And well, as a consequence, if you think about the cost of double spending attacks, well, if double spending attacks lead to a drop in the exchange rate, then as a miner, you really care if you have made this investment about the future exchange rate. And that's why you would not want to participate in a double spending attack because you know you lose so much future earnings. Now, in the model, and I will not discuss this in the presentation today, but we also consider an extension with cryptocurrency groups with transferable mining powers. And basically what we show is that, well, if you have tiny currencies with a very low exchange rate correlation, but they can be mined with the same hardware as some bigger coins, then basically transferability eliminates the protection that fixed costs provide to those currencies. So that gives an explanation why some of these small currencies get attacked so easily. And empirical results provide supportive evidence of our theoretical results. So I'm not going to show a lot of math during this presentation, but just a few quick figures. So basically here in the chart, you see the level of mining power, the response in mining power that you would expect for a percentage drop on the horizontal axis. So if the exchange rate doesn't drop, then mining power is 100% of its equilibrium value for any type of hardware. And if it is 100%, if the exchange rate is 0 for a cryptocurrency, then regardless of the mining hardware, there will be nobody mining that particular coin. However, the trajectory towards 0 is very different for different currencies. In particular, there's this threshold, which depends on the type of mining hardware, which basically is defined as the ratio between the fixed cost minus the alternative use value of the hardware, divided by the total cost of running the mining hardware over its entire lifetime. So that would be including electricity cost. So if you think about, for example, very general purpose hardware, software hardware that can be used for any purpose, well, the fixed cost minus the alternative use value is 0. You can use this hardware for anything. So this threshold will be really low. So you get close to this dashed line. So basically you would expect that there's a proportional decline in mining power whenever there's a drop in the exchange rate. But if you have the other extreme where you have ASICs, where you can only use the hardware to mine a particular cryptocurrency, then this threshold will be high. When there's a drop in the exchange rate, basically miners will continue mining until the drop is large enough and exceeds that threshold. And then only then you get to a point where basically it is no longer profitable for miners to continue mining. It's better for them to stop, because basically mining no longer covers their electricity costs and their other operating costs. So we run this in an empirical model. Basically, we estimate a simple model where we estimate the change in the mining power, how it responds to changes in the exchange rate, and we allow for path dependence. So basically, we also include changes in the past peak of a cryptocurrency. Now, if you think about the variable cost model, basically the only thing that should be relevant for current mining power is the current exchange rate. And there should be absolutely no path dependence. So you would only expect that the coefficient beta 1 would be significant, but in a variable cost model, beta 2 cannot be significant. There should be no path dependence. But then on the other end, if you think about more from that kind of this model with fixed cost, you can think about a situation where basically the network it expands. You would expect different responses depending on whether there's an increase in the exchange rate or a decline in the exchange rate. As I already mentioned. So basically, what you can think about by including this peak is basically if you allow the mining power to respond stronger than changes in the peak level, you can think about it like that's when we allow basically the mining network, mining capacity to increase. But then basically, but then when there's like a negative shock to the exchange rate, we would expect the mining power not to respond actually because of the presence of fixed costs. So in a model with fixed costs, you would actually expect that the coefficient like beta 2 would be significant. And in practice, you observe that is the case. So we estimate this for a large number of proof of work cryptocurrencies, big cryptocurrencies, and we also estimate it for smaller ones in the paper. And basically what you observe is that there is strong path dependence, which is consistent with the story with fixed cost. Now, of course, there is something happening when there's a drop in the exchange rate, and this is that the present value of your mining hardware drops. So if you have general purpose hardware, basically the present value of owning that hardware doesn't really drop when there's a drop in the exchange rate, because you can use it for other purposes as well and earn the same. But if you have very specialized hardware that can only be used to mine that cryptocurrency, basically the present value of continuing to mine drops in response to that negative shock. So if you think from the perspective of somebody who owns that hardware, there are basically two costs to an attack. First, when you mine coins during the attack, you have to sell them against the lower exchange rate, because the exchange rate might drop in response to the attack, like what happened with Bitcoin Gold. But secondly, there's this lower present value of future mining rewards, because now you will be earning mining rewards that you have to liquidate against the lower exchange rate. And that is an effect that you only have with fixed cost. But of these two effects, B is the largest. And just to show you a quick calibration exercise. So if you look at panel A, so that's basically calibrated based on the current on Bitcoin and the current Bitcoin mining rewards, which includes the block rewards and the mining fees. So if you think that, if you thought about a hypothetical exercise where Bitcoin were mined with a hardware that would have a 100% alternative use value.
Martin, 1 minute left.
Thank you, Paola. We would think about a hypothetical situation where Bitcoin were mined with hardware that had a 100% alternative use value. Then for an attack to be profitable based on this calibration, you would only need, as an attacker, to be able to double spend about 510 coins. If your attack would be for your attack to be profitable, at least in a situation where you anticipate a drop in the exchange rate of, say, 60%. But if the alternative use value were 0, then in fact you would have, in order for the attack to be profitable, you would need to double spend more than 500,000 Bitcoins, which of course is a thing that's really hard to do. So that provides a lot of protection to Bitcoin. You can also think about this as an extreme scenario looking forward, where block rewards have become 0 and perhaps transaction fees are the same as they were in 2019. And basically what you observe is that these numbers, of course, drop, but they don't become as small as in a situation where you would have an alternative use value of 100%. So the specialized hardware, mining hardware that is used to mine Bitcoin provides some protection against double spending attacks. Now in the paper, we also consider transferable mining power. So what happens if you have multiple cryptocurrencies that can be mined with the same hardware? So basically here you quickly see the responses of the mining power of a cryptocurrency A if there's a shock to the exchange rate of cryptocurrency B. I'm not going to talk about this in detail, but it's just in the paper. So if you find this interesting, please take a look over there. So just a few quick concluding remarks. So accounting for fixed cost and alternative use value is crucial to understanding mining behavior and double spending attacks. There's a basic truth. ASIC mining, which involves fixed cost and low alternative use value, it reduces the profitability of double spending attacks. Of course, there are other issues with ASIC mining that I haven't touched upon, among others, the centralization. But based on this economic model, basically what you observe is that this specialized hardware basically provides some protection against double spending attacks. This also weakens potential doomsday predictions regarding the future viability of Bitcoin. Some people believe that in the future, when there will be no block rewards, that it will be impossible to have really final payments on the Bitcoin blockchain because the rewards are not enough for miners to do the right thing. And then fourth, well, cryptocurrencies, they may be less protected when they don't rely on specialized hardware, or when they are tiny compared to peers that use the same hardware, and that is in the extension of our model. Thank you so much for your attention, and thank you for chairing, Paola.
Thank you. Thank you all. And we are running out of time because we are around 6 o'clock, and the panel, yes, there is one question, very quick question, Ferdinando, and then I'll close the parallel session.
Very quick. I mean, I'm very intellectually pleased by your result, Martin, and as probably you might expect. But so I wonder, I mean, this is kind of a contrarian opinion, your opinion, your result, because people are usually very, there is a strong criticism of mining, and there are, let's say, even the second network after Bitcoin, Ethereum, plans to move away from proof of work to proof of stake. What is your opinion? Should they reconsider in a way, or something, or your results should come forward to the fact that proof of work with dedicated hardware is the way to go?
That's a hard question to answer because our paper really considers proof of work. And proof of stake, it has other potential security issues. It also has some really nice features in the sense that basically there are almost no variable cost. So there's almost, you could consider it as if you would have to invest in hardware, but the hardware wouldn't be real hardware. It would be coins. So in some sense, perhaps that provides you with even stronger incentives than having very specialized hardware. But it is definitely a very interesting question to think about how proof of stake inherits these features that you observe with specialized hardware and proof of work in terms of security.
There is another question from the attendee. Is there any negative effect of centralization of mining? If yes, is it possible to solve it in practice?
Well, let me focus on 2 points that people have mentioned about like the risk of centralization. So first is the first point is resilience. A more centralized network could be less resilient. For example, if you're located in one jurisdiction, perhaps if that jurisdiction no longer likes Bitcoin or the other cryptocurrency that you're mining, they could close down your operations, and then the mining power is gone. But it could also be simple, like natural disasters, like floods. A second thing that people have raised in terms of Bitcoin, what people tend not to like is distributional features of centralization, because with centralization, basically the mining rewards only go to a very few parties, basically those who are involved with mining. So it is really hard to solve this, and I'm not really sure whether you actually solve it without specialized hardware, because what you observe in an equilibrium in an economic model is that basically what will happen in equilibrium is that your profits as a miner on generalized hardware, say for example your own computer, that in the end that the profit that you make tends to go to zero, because in the end people will just join and also start mining until the point where mining no longer covers the electricity costs. So in that sense, even in such a situation, the mining rewards could just go to people who live in areas where electricity costs are low.
Okay, thank you for all the suggestion and all the presentation. If there are any other questions, you can send it directly to the presenter, and on the website on the conference you can also find the papers. I sent you the link for the panelist session, the final session. Before leaving, I would like to just remind and thank our sponsor, Schich, Deloitte, and Rock Trading. And finally, please, we would like to invite you all to submit your very, very interesting paper to the special issue in economic notes. We will give you all the details later on. Thank you very much, and see you in 2 minutes in the panelist session. Bye, thanks again.
Thanks a lot. Thank you.
Thank you very much.
Thank you.